All right, let's talk about BNY Mellon. They just posted some seriously impressive numbers for the quarter. But what's the real story behind that success? That's what we're going to dig into right now. Let's do it.
So, you hear from the CEO, Robin Vince, and he says they had a strong quarter. Okay, strong is one word for it, but I think that might be putting it mildly. Let's look the actual proof.
And boom, here it is. This is the headline number you need to see, a 25% jump in earnings per share year over year. I mean, that's huge. It's a massive signal that things are heading in the right direction, and it really sets the tone for everything else. Okay, so a 25% jump doesn't just happen by accident, right? So how'd they pull it off? Let's get into the nitty-gritty and see what's powering this performance. First things first, you've got to look at the top line, revenue. They brought in a record-breaking $5.1 billion. That's up 9% from last year, which is just solid, healthy growth. But here's where it gets really interesting. Bringing in more money is great, but what about what's going out? Well, their expenses, they only went up by 4%. So you've got revenue way up and costs barely budging. This right here is the secret sauce. And this chart just lays it out perfectly, doesn't it? Look at that gap. Revenue growth is more than double the rate of expense growth. That creates this incredible effect. It's a concept called positive operating leverage. And trust me, for a giant institution like this, achieving that is like striking gold. It's the absolute best sign of efficiency.
So, what is this operating leverage thing anyway?
Don't worry, it's pretty simple. Just think of it as the difference in speed between your income and your spending. When your income is running way faster than your spending, well, that's when the magic happens. Your profits just naturally start to expand. And what does that magic look like in real numbers? Check this out. A pre-tax margin of 36%. A return on tangible common equity, that's a fancy way of saying how well they make money off their main assets, of almost 26%. These aren't just numbers on a page. They're proof that the company isn't just getting bigger, it's getting smarter and way more profitable. All right, so we know that they're making money, but the next question is how? Where is all this growth actually coming from? Let's peek under the hood at their different business units. Okay, engine number one, Securities Services. This is a huge part of their business, and man, it was just firing on all cylinders. Revenue was up a solid 11%. But remember that operating leverage? Because of that, the profits from this division skyrocketed by 26%. That's awesome. Then you've got engine number two, Market and Wealth Services. This one was even stronger on the revenue side, jumping 14%. And this wasn't just a fluke. It was broad-based growth for more client money, more activity, and just plain winning new customers. And the result? You guessed it, profits jumped 24%. Now, the last major piece of the pie, investment and wealth management, is a slightly different story. Here, revenue actually dipped a tiny bit. But, and this is so important, because they're so focused on keeping costs down, they still managed to grow profits by 5%. That just goes to show how powerful that disciplined expense control really is. Look, numbers like these don't just fall out of the sky. They're the result of a deliberate plan. So let's connect the dots between these results and the actual strategy they're executing. The CEO, Robin Vince, actually called out two key things. First, they've got a new commercial model that's just better at driving sales. Simple as that. Second, and this is a big one, is what they call a platform's operating model. Basically, they're rebuilding their internal systems to be way more efficient and connected. And they are definitely not resting on their laurels. You have to hear this quote about AI. They're going all in, even launching their own internal AI platform called Eliza for every single employee. The goal here is pretty clear. Use technology to get even more efficient and find new ways to grow down the road. Okay, so the numbers are great, the strategy seems to be working, but what about the so what factor? What does this all mean for investors, for the people who actually own a piece of the company? Let's talk about the payoff. And here it is, the bottom line for shareholders. In just one quarter, BNY Mellon returned $1.2 billion to them. That's not just a number. That's a direct reward for the company's strong performance, a tangible result of all that growth and efficiency we've been talking about. So how did that $1.2 billion get back to investors? Well, it was a two-pronged approach. You can see the bigger slice of the pie here. $849 million was used to buy back their own stock. That helps make each remaining share more valuable. And the rest? $381 million was paid out in good old-fashioned cash dividends. Both are classic ways to reward your shareholders.
So let's wrap this up. It was a fantastic, record-setting quarter for BNY Mellon. They're growing revenue, they're managing costs like a hawk, and they have a clear strategy that leans into tech like AI. Everything looks great. But, and there's always a but, the big question is, can they keep it up? In a world where finance is changing at lightning speed, can this momentum last? Well, that is the billion-dollar question, isn't it? Thanks for tuning in.